Okay, so what I'm going to do next is I'm going to spend the next 35 minutes before handing over to Teresa, talk about a specific research project in this space that I've worked on. And this is joint work with Sumit Agarwal at the National University of Singapore, Sufala Chomsy-Sengphet at the Office of the Control of the Currency, and also Neil Mahoney, whom you will see present some other research later on in the afternoon. And the paper is entitled "Regulating Consumer Financial Products: Evidence from Credit Card." And the motivation for this paper for us was this surge of interest in regulating consumer financial products that we saw following the 2008 financial crisis. Following the financial crisis, the Dodd-Frank Act put a lot of restrictions and regulations in the mortgage space. It also set up the CFPB, the Consumer Financial Protection Bureau. It's since been renamed somewhat, to really focus on regulating markets for mortgages, payday loans, student loans, credit cards, etc. Because these were markets that didn't really have a sort of obvious primary federal regulator. Why was there this surge of interest in regulating these markets? Well, proponents of this type of regulation, they would say, well, look, we have a lot of evidence now, and you'll see some of that evidence today, that consumers are really subject to these extreme behavioral biases. And not only are they subject to these biases on average, but particularly poor households are even more subject to these biases. And so you have these unsophisticated consumers on the one hand who make sort of ways in sometimes predictable ways, and on the other hand you have the producers, the banks, the credit card companies, the mortgage lenders, etc., who are very sophisticated players and who might go out and actually design products that are specifically set up such as to exploit the various behavioral biases that consumers have. And so in the absence of any type of regulation, we're really going to have these sophisticated producers taking advantage of the unsophisticated consumers. And as a result, coming in and regulating these markets can really improve consumer welfare, can protect consumers, etc. Skeptics of this type of regulation actually argue that, it's actually quite hard in practice to transfer surplus from producers to consumers in an effective way. And the idea is, that the regulator ends up playing, some sort of, what Neil and I called regulatory whack-a-mole. Right? Whack-a-mole is this American game where you have sort of a mullet, and then you have little heads pop up, and you try and hit them, and as soon as you hit one head down, some other head pops up somewhere. Again, the analogy here is to say, what regulators do is to go in and maybe they regulate one specific fee or one specific market, but as soon as you do that, some other fee or some other market might pop up, and consumers don't actually end up being much better off as a result. So Sendel Muller-Nathan, who I would say probably a proponent actually of regulating these markets, says, look, if you're going to reduce some sort of fee, this reduced revenue stream would actually mean that other rates and other fees would need to be adjusted to compensate. And then secondly, even if you think that these are markets in which you may want to go in and regulate, it's not upfront obvious how you would go in and regulate. And there's an entire spectrum of possible actions that you could take. So in one extreme of that spectrum is you could go in and basically prohibit certain types of products or prohibit certain types of behaviors. Basically say, look, no credit card company is allowed to charge an interest rate more than 30%. Even if a borrower wants to pay more than 30%, the company wants to lend to them at more than 30%, which is going to prohibit this type of behavior. So that's in some sense the most paternalistic end of that spectrum. And then you have another, at the other end of the spectrum, where the types of interventions might be nothing more beyond providing some additional information to consumers. So the idea is to say, look, maybe we're worried about that households don't understand what it means to pay 24% interest. And so if we could only design a way of going in and providing them the information on, what that actually means. If they then still want to do it, we shouldn't stop them from doing it, but we should at least make sure that they have the information, the understanding to make those decisions. And then there's a potential set of, interventions, in the middle, things like the setting of default options and so on that, that can also play an important role. So not only, do you worry about which regulations are effective? You worry, what should you do? And, in some sense, where you come down here is, it's a combination of both, what works, right? But also, a little bit of sort of your political view. If you're more of a free market type person, you like providing information. I think almost everybody's in favor of providing the right informations. And the more you might be willing to say, look, the government, the state has some paternalistic role. It has some sort of role in terms of actually stopping people from making certain types of mistakes, that's important. And interestingly, this is not just about consumer financial regulation. You have these types of questions for almost every decision. And every regulatory decision. Think about the medical trial space, right? So we say, well, we have a medicine, and I don't know, like it helps some people, but it kills 1 in 10 people that takes it. What should the FDA do? Should the FDA just prohibit this type of medication being sold in the first place? Or is the only thing that they have to end up doing say, well, as long as we make sure that the packaging material very, very clearly states that 1 in 10 people dies, well, if the people then still want to take the medication, we shouldn't stop them, right? That's like their own decision, and we don't want to intervene there. So again, things like regulation of drugs and other products face that same trade-off. How much do you want to just provide information versus how much do you actually want to prohibit certain types of behavior? So we're going to study this question with respect to the credit card market. And so why are we focusing on the credit card market? Well, one reason is that the credit card market is seen by many as particularly exploitative. So this is from Chris Dodd, of Dodd-Frank fame, and he wrote that the whole business model of the credit card industry is not designed to extend credit, but to induce mistakes and trap consumers into debt. This is an industry that's been thriving on misleading consumers. So really exactly this idea, you have these unsophisticated consumers on the one hand, and then you have producers, banks on the other hand, that specifically design products knowing the types of mistakes that consumers might make. And so, because there was, a substantial, belief in Congress that, there was at least some truth to this statement, in 2009, Obama signed what was the Credit Card Act, or the Card Act, which is going to be the specific piece of regulation that we're going to be studying in this project here. And the Card Act had a number of interesting features. That make it particularly interesting to study. And in particular, the Card Act had a number of elements that covered sort of different parts of that effectiveness spectrum. So the first thing that the Card Act did is it limited the size of late fees. And it restricted the use of overlimit fees. So what it did on the late fee side, late fees, basically you have a credit card, and if you don't make your payment by a specific point in time, you get charged a late fee. And it used to be that late fees were usually $40, and the Card Act just says you can't charge $40 anymore, you can only charge at most $25 now. There were also overlimit fees. So overlimit fees are fees that you end up paying if you want to charge transactions to your credit card that would take you over your credit limit, right? And so what it used to be is that prior to the Card Act, the default option for every credit card was that if say you have a $1,000 credit limit and you've already spent $950, if you then go into a store and you want to spend an extra $100 on the credit card, which would take you over the limit, that basically they would process that transaction, but they would charge you say a $60 over limit fee just to transact. Now, what you could do prior to the Card Act is you could call up and say, actually, I don't want you to process this transaction. What I want you to do is just to decline it. Right? What happened after the Card Act was that the default option switched. So now if you didn't take any action, what would happen if you were trying to charge that extra $100 is that either the card would be declined or they would process it but not actually charge you the overlimit fee. And the only way that they could charge you the overlimit fee is if you actively opted in. So if you called up and said, yes, I want you to keep processing my overlimit transactions, and yes, I'm happy to pay the $60. Now, what's interesting here is that this is sort of an intermediate option between the two polar extremes that we talked about before, in the sense that it doesn't prohibit overlimit fees, but it changes the default option. So both, the decline and don't charge me, as well as the process and charge me options, were available prior to the and after the Card Act. But the only thing that changed is whether or not, if the consumer took no extra action, what would be the default option. And then the third part of the card act that we look at is a provision that was focused on providing information on the costs of only making the minimum payments, right? So in other words, it was, and I'll show you the exact information intervention, but it was a provision that would try to tell people how expensive it is to actually borrow on their credit card. So this is a pure information provision. The card act had a bunch of other provisions too, but we're going to focus on studying these three and trying to figure out how effective they were. Even with the card act, people were, people thought that this type of regulation wouldn't work, right? So, the American Bankers Association, which, in fairness, is the lobbying group of the banks, to take what they say with a grain of salt, right? They said, look, it appears that there have been significant trade-offs. Average credit card interest rates have increased in result to this. Again, here's the idea. You stop us from charging some fees, some other interest rates go up. And so what we're going to do in this paper is we're actually going to analyze whether or not that statement is correct. We're going to analyze both the intended and the unintended consequences of the card act. And we're going to try and use this specific setting to teach us something more general about consumer financial regulation going forward. What types of regulations, worked in this specific setting, why did they work, and sort of what does that tell us about what might work in a different setting. So the data we're going to be using for this project comes from the OCC, again, the Office of the Controller of the Currency. It's a large banking regulator in the US. And so the data set we have is pretty cool and was somewhat unique at the time when we're working with this. So it's an account level panel data set on all credit cards issued by the 8 largest US banks. So here we're talking about 170 million credit card accounts, 30% of the market, and we have monthly data on these between April 2008 and December 2012. And what we can see in this data set is more than you can see in a lot of other data sets, such as credit bureau data set, etc. So we can see households' consumer credit score, their FICO score, but we can see all the credit card, and really importantly for the question we're after, you can see all of the fees and all of the interest charges and interest payments that these households make. This is something that quite often you can't see in credit bureau data. So it really has all of these various cost components in there that allow us to get this sort of broader picture on the overall profitability of credit card lending. And so the first thing that I want to do with this data is I want to just understand how this how this business model of credit card lending looked like prior to the regulation, to get a sense of where the regulation might or might not have been effective. And the way we're going to do this is we're going to show you both revenue and cost drivers differentially for different FICO scores in the pre-card act period. And to make different numbers comparable, what we're going to do is we're going to express all of them as a fraction of borrowing volume. So the way you can think about that is as an interest rate equivalent. That's important because, as I was saying before, some of the fees might only be $40 or $60, but if you pay a $60 fee, but you're only borrowing $500, that very quickly, it becomes a very large implied interest cost, so 12% in that example. So we want to, just to make the different components comparable, express everything as a percentage of borrowing volume. So what we have in this first panel up here is finance charges, or just interest rates. What you can see here on the horizontal axis is the FICO score. This is the consumer credit score. Higher FICO score are individuals who are less risky. And what you can see is that, interest rates are declining in FICO score. That makes sense. The less risky individuals pay lower interest rates. But really importantly, for sort of the subprime segment of the market, people below 660 or 620, depending on your definition, they were paying about 20% interest through the interest rates that they were paying on their credit card accounts. This is a number that was known prior to us looking at the data, in part because when you live in the US, you get these credit card mailings all the time, and so there's a data sets such as Mintel, which people like Ben Keys and others have worked with a lot over the years, and kind of really gotten some really great insights out of, which collects these credit card mailings that people get sent around. And so we had some relatively good idea of what interest rates looked like. What we didn't have a good idea, at least Neil and I didn't, before looking at this data, is what sort of the interest rate equivalent cost of the fees was. And so this is what we're plotting up here. So it's the interest rate equivalent on the fees. So the first thing you notice is that essentially the non-subprime people, so people with 680 credit scores and above, they almost never ended up paying any fees. right? And so the extra cost to their borrowing that comes from these overlimit, late fees, etc., is in the order of magnitude of 3 or 4%. So it's not that important. But what you also see is that in this subprime segment of the market to the left, the individuals were paying more in fees than they were paying in interest rate. And so for sort of the lowest creditworthiness individuals, they were paying an equivalent of something like 36, 37% interest just in their fees. And that's on top of the 22, 23% that they were paying up here. So if you combine these two, these are individuals that were paying up to about 60% equivalent interest, just to borrow on their credit card. And again, that's because a lot of these people don't have very high credit limits. And so, if your credit limit's only, $1,000, very quickly, if you have 5 or 6 of these $60 fees within a year, that very quickly adds up to about 30% interest rate equivalent. So you can see why this fee revenue was sort of a specific target that the Card Act focused on. Then the other components, I'm just going to focus on this one here. These are write-offs, so these are loan losses. So you can see that the low FICO guys were particularly risky, and you had higher loan losses than the high FICO guys. So the loan losses for these guys was about 50 cents on the dollar per year. And again, higher FICO guys were less risky. So when you combine all of these components and you looked at the profitability of credit card lending by FICO score, you get a graph like this. Now, what's important to realize here is we're not looking at expected profits, but we're actually looking at realized profits. Over what period? Well, because of the data we have, we're looking April 2008 to February 2010. This was the depth of the financial crisis. This was the depth of the Great Recession. When you were doing mortgage lending during this period, you were losing a tremendous amount of money. And yet, what you can see is that banks were actually, even during this terrible, terrible period, making substantial amounts of money. This is equivalent, to a 15%, 10 to 15% return on assets. When you then think that these guys are levered 10 to 1 or something like that, this is like over 100% return on equity on their credit card lending, even during the depth of the Great Recession. And again, this low FICO segment, despite the fact that you see these high loan losses, you have to write off 30, 40, 50% of every loan you make every year, because you end up charging them both through interest and particularly through fees so much money, you end up actually making this very, very profitable. So credit card lending was an extremely profitable segment of consumer lending, even during the Great Recession. And you can only guess how profitable it would have been during other periods. So this is kind of the setting and the way the world looked before the Card Act came into effect. And so what I want to do next is I want to talk to you a little bit about the research design we're going to employ to answer this question. What was the effect of the Card Act? Then we'll talk a little bit about the intended effects, and we'll talk a little bit about the unintended consequences. Here we're really going to look at whether or not this pass-through really was happening, this higher interest rate. So the challenge with the research design is that what you can't just do is you can't just look at, say, how interest rates moved before and after the Card Act, or how fee revenue moved before and after the Card Act. Why? Well, because the Card Act came into effect, in 2009, and we talked about before, the 2009 was sort of a depth of the Great Recession type period. So there's a lot else going on in the time series why maybe the period after the Card Act might have looked different to the period before the Card Act. And so what we're going to do is we're going to use a research design that you'll see very frequently in empirical work. It's a difference in differences research design. So basically what we do is we look for another segment of the credit card market that happens to be excluded from the Card Act, so not covered by the Card Act, but that gives us a good counterfactual of what would have happened in the consumer credit card market had it not been for the Card Act. In other words, we're looking for a control group. And what turns out is that in this specific setting, there's a subset of the credit card market, it's much smaller than the consumer credit card market, that was explicitly excluded, or maybe said different, not explicitly included to be covered by the Card Act, which is the small business card segment of the Card Act. So small business credit cards are essentially very similar to consumer credit cards in the sense that they're guaranteed usually by the personal assets of the individual. So this is not some sort of, business credit card the way, you think about an expense card at a large corporation. Most of these small business credit cards are sole proprietorships and so on. And so really all of the assets are the individual's personal assets. They're quite often underwritten on the personal FICO score of the borrower rather than anything to do with the business, because most of these businesses, again, are very small, that don't really exist. They're issued by the same business units within banks. They're quite often jointly assessed by the same regulators. And so there's a lot of reasons from an institutional perspective to think that maybe what's going on in the consumer in the small business market gives us a sensible counterfactual for what would have happened in the consumer credit card market in the absence of the Card Act. As with all differences analyses, you can actually provide supporting evidence of that identifying assumption, because what you can show is that prior to the Card Act, what was going on in the small business credit card market moved in parallel to what was happening in the consumer credit card market. And I'll show you some evidence that that's true down the road. So again, what we're going to do is we're not just going to compare before and after the Card Act in the consumer credit card market, but we're going to compare differential before and after in the consumer credit market versus the small business card market, which gives us this counterfactual. We're going to do a pretty standard differences in differences specification for econometric models. There's almost no innovation here. And in fact, in the interest of transparency, what I'm going to show you today is I'm just going to show you mean outcomes over time. So I'm not going to really focus on showing you the difference in differences coefficients, but really mean outcomes over time. And this is something that I emphasize a lot in my, in my PhD classes, which is that, I think if you can see the results in the raw data, that beats putting any structure, even the structure of a very simple econometric model, onto your data. The more structure you put on, the more people start worrying that the results only survive, after you've controlled for all this stuff, etc. So if you can see the results already in the raw data, you're better off just showing the raw data rather than kind of going and doing the econometrics. Okay, so let's start looking at the intended effects. And the first thing we're going to look at is fees. And fees, in some sense, this was the primary category of intended effect. So, the Card Act said you can no longer charge over-limit fees. And so here is what you see. So let me walk you briefly through what's going on in this graph, because it's it's going to look similar to a lot of the other graphs that I'm showing. So this on the horizontal axis is time, and on the vertical axis has the over-limit fees. This is focusing on subprime accounts. Over-limit fees again is a percentage of ADB. So again, you can think about this as the the interest rate equivalent cost of paying over-limit fees. The blue line is going to be the consumer accounts, and the gray line is going to be the small business accounts. And so the three bars are sort of the three different time periods when different parts of the Card Act came into effect. And so one really salient thing that you can see here is that, in February 2010, when there was this shift in the default option around over-limit fees, essentially over-limit fees dropped to zero in this market. Sometimes this was the intended effect. Now, I told you before that all that happened was there was a switch in the default option. What the fact that those fees go to zero tell you is that essentially no one called up their bank and said, please process my over-limit transactions and just charge me this fee, right? So no one really did that. You stayed at zero. The gray line tells you what happened to annualized over-limit fees in the market that was very similar to the small business market, but was not affected by the Card Act. So first of all, in terms of the parallel trends, you can see that in the pre-Card Act period, you can see that the small business and the consumer credit card accounts actually moved nicely in parallel, and then at exactly the point in time when the fee revenue on the consumer credit cards collapsed, there was no effect whatsoever on the small business credit cards. Again, making you even more confident in a statement that says the decline we see on the consumer accounts is really, the result of the regulation rather than, the result of, of sort of confounding macro trends. Here is how the diff and diff coefficients look like. And again, you have parallel trends in the pre-period, then a decline, and then parallel trends again afterwards. So it's really this level shift that you get just at the point in time where the regulation comes into effect. Now, one important question here again is, well, did this reduce the access to credit for people who wanted to go over the limit? Because one thing someone might say is, well, look, these people, they don't get charged over limit fees anymore, but maybe the ability to go over your limit was actually a very attractive thing for individuals. Why? Well, because maybe you're really credit constrained and you really need to buy something and you've maxed out your credit card. And the only way you can buy it is by going over the limit. If I can now no longer go over the limit, that might actually make me much, much worse off. Right? So what we do is we look directly, both in the consumer credit card accounts and in the small business accounts, at the fraction of individuals that go over limit. And you can see that, in February, that fraction goes down by a little bit, but actually it goes down both in the consumer and the small business credit card account. So it looks like the reason, in the time series people stopped going over the limit is really because the economy is slightly recovering, by 2010, 2011, and it's not really anything to do with the Card Act. What does that mean? It means that the options bank took was to say, look, we'll process these transactions, but we just won't charge you this fee anymore, right? So it didn't stop people from going over the limit. The primary thing it did is that it made it just that you didn't have to pay this fee anymore. And you also see the same when you look at other fees, right? So you see late fees also decline. Remember, those were the fees that were reduced from $40 to $25. And you don't really see an increase in any other fees. So you don't really see an increase in annual fees or any of the other fee categories that we observe. So at least on the fee side, we don't see any of this whack-a-mole. We don't see, well, you told us we could no longer charge, over limit fees. So what we're going to do instead is we'll just charge a higher annual fee, right? This kind of fear that people had doesn't seem to bear out in the data. So quantitatively, what does this add up to? Well, it adds up that the total decline in fee revenue paid by consumers and earned by banks declined by about $12.6 billion annually, which is approximately equal to about 1.7% of borrowing volume. So this, restrictions on the fee revenue side was equivalent to, a 1.7% reduction in the interest rate paid by individuals. Now, what's important is we saw this before, most of these fees were initially paid by these low FICO score consumers, individuals with FICO scores below 660. And unsurprisingly, the reduction in borrowing cost was also largest for them. And so for those individuals, who might have a particularly high welfare weight, this reduction in implied cost of credit was large at about 5.5 percentage points, right? So it looks like on the fee side, the regulation did exactly what it hoped and intended to do. Okay. So let's now look at the other set of, of regulations put in place, in particular the Payoff Nudge. What is the Payoff Nudge? Well, the motivation for the Payoff Nudge was the following. It says, look, about 28% of people really max out their credit card and they don't repay at all. Right? So some people use their credit cards just as a means of liquidity and repay their balance in full every month. But a lot of people basically only make the minimum payment or less. And this fraction is particularly large for low FICO guys. So low FICO guys, about 40% of them, make no payments on their credit cards. And so there's a question about why do they do that, right? Is this optimal behavior on their part? Or, because, they really value the credit, even at these extremely high costs of credit? Or is this because somehow they don't really understand how expensive it is to borrow at at whatever the interest rate is, in part because the interest rate is reported as an APR, and APRs compound monthly, and even our MBA students struggle to understand compounding well. And so maybe people just don't know how expensive it is, and if you just provide them with information about how expensive it is to borrow on your credit card, maybe then you're going to see a differential behavior. And so the regulation came in and said, look, every credit card statement out there will now have to provide the following information to individuals. The first thing it has to provide, and it's this box here, which is sometimes called Schumer box, after Chuck Schumer, who pushed this a lot, this piece of regulation. And so it says, look, if you make no additional charges using this card, and each month you only make the minimum payment, right? It'll take you 10 years to repay your balance, and the total amount you'll pay over those 10 years is $3,284. If, on the other hand, you make a slightly larger payment, in this case ends up being $62, you will pay off the balance in 3 years, and the overall cost to repay your current balance is a lot less. It's $2,200, and you'll save over $1,000. Right? Where does the 62 come from? The 62 comes from that, basically you had to solve the annuities pricing equation for 3 years. So every person got given whatever amount it is that they have to repay, such that they would repay their balance within 3 years, right? So this is sort of, the equation that you have, T equal 1, like if you solve it for T equal 1, right? You basically make the full repayment. T equals 36, which is basically the repayment that you have to make to repay within 36 months, 3 years, is usually about 3.5% of your balance. So the $62 will not be a lot more than the minimum payment, but the savings will be pretty substantial. Right? And so the question now is, right now after the Card Act, we have this piece of regulation there. Everyone gets shown sort of this, this payoff nudge. What happens to behavior? Right? So let's look at what happens to behavior. So I'm showing you in this specific graph here. It's one of my favorite graphs in the paper. What I'm showing you is the histogram of payoffs that individuals were making, both before the Card Act and after the Card Act. The black line gives you the histogram before the Card Act, and the blue line gives you the histogram after the Card Act. And basically what we do is we say, if you keep making that same payment that you just made, how many months would it take you to pay off your balance? And one of the things you see is this very obvious increase in mass of payments that you see right here. And where is it? This is exactly at 36 months. So what does that mean? It means that there is a substantial number of individuals, about 0.5% of the population, that after seeing this box and after seeing this piece of information says, oh, I'm now going to shift to the $62 here, which will repay within 3 years, right? So it does look like you're affecting the behavior. Now you might say, well, this is a real success of the regulation. Why? Well, because it's actually quite cheap to provide people with information. And you look, we actually were able to shift people's behavior quite dramatically towards making this repayment here. Now, one thing that's actually quite tricky is you don't really know what the alternative payments of these people would have been, right? And when we actually look in the data, it's very unclear whether or not these people would have otherwise made a larger payment or would have otherwise made a smaller payment. And we find, in fact, absolutely no evidence that this nudge increased overall payments amounts, right? So it looks like some of the people that moved to, to this point here, the 36 months, would have actually otherwise made an even larger payment. So they would have usually paid off $100. Now they pay off $62. Why do they switch to $62? I think, honestly, the most plausible interpretation is people are quite unsophisticated. They don't really know what part of their credit card balance they should repay at every given point in time. And so when they see this, they think, well, and this box would come with, some statement of, the regulator forces us to show you the statement or whatever it is. I think, well, somebody must think that $62 is the right amount for me to pay off. And in the absence of a better idea of what the right amount is, I'll just pick that. But some people might have actually picked $100 otherwise, for example. So it's unclear whether or not, this actually leads to an increase in repayment, even though it does lead to a change in behavior. But even putting that aside, let's make the most charitable interpretation of this and say, well, what's really going on here is that everybody who ends up making the $62 now would have previously repaid $0, right? That's in some sense giving this policy the biggest possible effect it could have. And even then, what you see is that the total annualized interest savings would have been about $70 million a year, right? That's 2 orders of magnitude smaller than the $12.6 billion you got from the, the fee regulation. Now you might say, oh, well, the fee regulation is very, very heavy-handed. This is very cheap, so we should do both of them. I think the one thing to bear in mind here is that, yes, it's actually quite cheap to come up with these types of nudging policies. But when you do this through federal law, the primary thing it does, it takes up time in the legislative process, right? So people had to, senators had to spend a lot of time kind of figuring out exactly how to present the information, exactly how to write this piece into the law. And really the opportunity cost is doing something that ends up being much, much more effective rather than focusing on, these policies, which, yes, while they have an effect, and it's quite a statistically precise effect, doesn't seem to actually give you sort of quantitatively very large amounts. Here you see the same 2 graphs for the consumer credit cards, the control group, and you see that there's nothing there, which really, makes you very comfortable that this spike we see here is due to the, the information provision in the Card Act. Okay, right. So what I want to do the last 5 minutes is I want to assess these unintended consequences. Remember, I started out telling you how people, that even proponents of who think that in principle you should regulate these markets say it's actually quite hard to regulate because, I'm going to reduce the fee revenue now, but say they'll just increase the interest rate. And you even saw the statement by the American Bankers Association who said that they ended up increasing the interest rate, right? So I want to walk you very briefly through a small theoretical framework to think through when we would expect this type of perfect pass-through. Under what states of the world would I have expected the reduce in fee revenue to lead to an offsetting increase in interest revenue? Right? And the paper has a formal model of this. I'm just going to walk you through the simple intuition. Well, the first state of the world I would have expected this is if price had been equal to marginal cost. Right, so if price is equal to marginal cost, then the marginal loan I'm making in the pre-Kardec period, it just about breaks even. If now one of my revenues breaks down, I actually end up having lower revenue, still the same cost. I'm making a loss on the marginal loan, so I have to do one of two things: either increase another dimension of the cost, or I'm just not going to make that loan anymore. Right? Now, turns out that when you look at the huge profits that the credit card industry made in the pre-Kardec period, it makes it very unlikely that they were making zero, that they're making zero loans on the zero profit on the marginal loans. Now, even if you think, well, there's a monopolist out there, so price doesn't equal marginal cost. Even then, there is a state of the world where you would have expected the perfect pass-through. And I think this is the more interesting insight here, which is imagine a monopolist is pricing, and imagine the fee revenue is perfectly salient to consumers. So consumer basically says, look, the demand that I'm going to have to borrow doesn't really depend on whether or not the cost I pay to the bank is because I pay high interest rate or is it because I pay high fees. It's really the total cost that matters to me, and the composition doesn't matter to me at all. And so, I have a downward sloping demand curve. When the price goes up, I demand less credit. But I don't really care about the composition of the cost, whether or not it's fees or interest rates. And so the monopolist picks a spot on that downward sloping demand curve. After the Card Act, the bank can go to the consumer and say, look, you last year you paid $1,000 to borrow, 800 of that was fees and 200 was interest. I can't charge you the fees anymore. So what we'll do is I'll just charge you $1,000 interest, total cost to you is the same, you demand the same, and we end up in exactly the same spot. Right? And so if consumers thought that the fees were perfectly salient and they knew exactly that they would end up paying those fees, you would also expect perfect pass-through. But in a world where the fees weren't salient, where they're part of mistakes that consumers make, where consumers upfront think, well, I'm not actually ever going to be late, so I don't have to worry about the late fees. Then when the bank goes to you and says, look, I can't charge you late fees anymore, and you would have paid about 3 late fees and expectations, so that's $120, and I just want to increase your interest cost now for $120, but you shouldn't care, it's the same cost to you. The person will say, no, I was not going to be late. But the interest I have to pay with certainty. And so, this actually to me looks like an increase in my cost. And in that state of the world, you wouldn't expect perfect pass-through, right? Okay, so again, the paper has a formal model. If you're interested, it's not actually a hard model to think through, but these are the intuitions. So what do interest rates look like? Again, I'm just showing you raw averages here. And I basically see absolutely no effect. So interest rates of consumer accounts and small business accounts move in unison, both before and after the Card Act period. This is the diff. This is the diff and diff coefficient. The bottom horizontal line here is if there were no offset, and if it had been fully offset, i.e., if the entire fee revenue decline would have been offset by an increase in interest rates, you would have had to see this coefficient jump to this dashed full offset line up here. You see no evidence of that whatsoever. So what's the conclusion on the cost of borrowing? Well, overall, the profitability of credit card lending declined as a result of the Card Act. Fees declined by an annualized 1.7 percentage point of ADB, these $12.6 billion. Point estimate for the offset is 0. And that's consistent, through this logic that I highlighted up front with the fact that there's limited competition in these markets and that fees aren't very salient to consumers. Again, that a lot of consumers that end up paying these overlimit fees don't anticipate paying them up front, that it's just a mistake they make down the road. We also find 0 evidence on a decline in credit volumes. So, you just have to take my word for it. I'm running out of time. You can look at the paper, but there's no effect on credit limits. There's no effect on new accounts. There's no effect on average borrowing volumes. And again, that's consistent with this model we write down, right? So it doesn't look like credit gets more expensive, and it doesn't look like credit's getting rationed, right? And I think the combination of these two things is highly consistent with this model where the regulation was on a non-salient component of the overall cost. All right, so let me conclude on you know what I think we learned in this paper. So in terms of the intended effects, the fee limits really reduced the cost dramatically. It's about $12.6 billion. Actually, that roughly lines up with if you go to the largest credit card lenders and you go to their annual reports, and they have to justify to their shareholders why they're not making as much money as in the previous year. You know, the large lenders each say they lost somewhere like $2 to $3 billion profit a year from credit card lending because of the Card Act. You add that up, you get roughly this number here. So that's just, you know, a sanity check on our numbers. And this is corresponds to, for the low FICO borrowers, the low credit-worthy individuals, to a reduction in their cost of credit of about 5 percentage points. So it's pretty substantial. This nudge had a small but really noticeable effect on payoff behavior. And here it's kind of nice that we can get very precise estimates because, you know, we're dealing with hundreds of millions of observations. You can really see that displaying this information, does shift people's behavior, but we didn't really see any evidence that it increased aggregate payments. All we saw is that if you basically tell people, you know, $62 in some context, some of them will jump to $62, but it's very unclear whether they do that because they now better understand what's going on or because they're just looking for some anchor somehow about the type of payment they want to make. In terms of the unintended consequences, we really don't observe any offsetting increase in interest rates, and we see no reduction in credit volumes. And so what's the conclusion? Well, the conclusion to us in the end is that the skepticism about the effectiveness of consumer financial regulation, can it work? It's actually maybe, you know, a little overblown that it is possible for regulation to transfer surplus, you know, to consumers from producers in consumer credit markets. And importantly, in particular in settings with non-salient fees and imperfect competition, right? So if everybody had been fully aware of all the overlimit fees they were paying before the Card Act, you know, the model would suggest that actually you would see very, very little, you would see a lot of offsetting increase in interest rates if I just say I can't charge you these fees anymore, right? So it's really consistent with regulating, you know, non-salient aspects of consumer credit. And, you know, as you kind of think about design of these policies going forward, really focusing the regulation on non-salient aspect seems to be sort of a very, very promising direction to go.